All right, so welcome everyone. Welcome to our webinar today on business succession. Now, there's been quite a lot of interest, and as I said, we've got quite a few people registered. People are still attending and logging on, so I'll let people on as we go through it. But welcome everyone, and good to see you all. Just before we get started, just wanted to make sure that everyone can open up their chat box and just say hi. Let us know where you are if you haven't already. And most of our conversations today will be through chat. And as I said before to the people that logged on a bit earlier, we'll be having a Q&A at the end. So the whole aim of this webinar is that we'll spend about 40 minutes, myself and Heath, and I'll introduce Heath in a minute. Heath, do you want to just unmute yourself and say hi again to everyone?
Hello, everyone. Good to see some of you on the screen.
So Heath's obviously our resident commercial legal expert, which is obviously very important with this topic. So Heath and I will be presenting for around about 40 minutes, and then we'll have a Q&A, open Q&A for about 20 minutes at the end of the webinar. And as I said, I'm recording this, and so just most of the conversations will be through chat. Everyone's on mute. And if I can ask you to stay muted, that would be fantastic. Just as we're presenting, if you have any questions, any comments, just feel free to put it into the chat box, and we'll be monitoring that as we go. So firstly, I know everyone's very busy. Business is busy, life is busy. So I always like to welcome everyone and thank you for attending, obviously taking the time out of your day to learn and to contribute to discussions and so on. So I really appreciate that. So before we get started and before we do the intro and I go through an overview of the webinar, I just want to cover off firstly why we're here and what are the challenges that we generally see in this space of succession planning. And I'll just run through these very quickly. So firstly, there's a lot of uncertainty about the steps and what's involved. And that's because you've all probably built great businesses over the years, and you know now how to run a good business, how to attract staff, how to attract customers, how to deal with staff and grow your business and so on. But succession planning and this next phase of your business journey is obviously very new to people. So there's a lot of confusion around that. So hopefully after this webinar, you'll have a much better understanding of the issues, what to consider, what to think about, how to prepare if you are at that stage in your business journey. Secondly, you're really not sure who to talk to, or that's what we find. There are obviously accountants, there are different professionals out there, but generally there's not a lot of succession planning consultants. So it's sometimes confusing as to who to talk to and what they do. So we'll be covering that off as well. And I know that a lot of business owners, us included, can like control and like doing things a certain way in our businesses, and so therefore letting go and trusting others to start taking the reins can be a challenge, can take some adjustment for a lot of people. So that's also a challenge that we see people have, and just helping them through that process. Another area is how to value the business, and do I sell it at that market value, whatever that might be? Do I sell it at a discount to our managers that have been loyal to us or family members? And related to that is, how can the next generation practically afford to buy the business? A lot of the younger generation, they have a lot of debt with mortgages, other commitments, family, and so on. So sometimes people think, well, it'd be great if they could take over the business, but really I want to be able to maximize how much I get for the business, and can they really afford to buy the business? So we'll talk a bit about that as well. Sometimes I've seen people just put their head in the sand and say, it's just too much effort, it's too difficult, it's easier just to close the business. And I've seen people do that. And they think that because they've built up a lot of assets and wealth over their lifetime working for themselves and running a business, that they don't really need to get anything for the business, but it's really just leaving money on the table, and at the same time it means that your legacy that you've built doesn't get a chance to continue. Okay, so really want to give you the steps and a little bit more confidence about what's possible, so you can actually achieve this succession. And lastly, because everyone's so invested in their business, we spend so much time in our businesses, really adjusting to what life after business might look like can be a challenge for people as well. So I'd like to open up to all of you. Are there other things that you're thinking about so that Heath and I can cover those off in today's webinar? So just let me go back to the previous slide. They're the things that generally we're going to cover. Heath's obviously going to go through quite a bit of other commercial legal issues. But if there are other things that you'd like us to cover or that you're thinking about in terms of challenges, then open up your chat box and just pop those in. And I might continue. Steve saying CGT, yes, we will be talking about tax as well. Now, obviously, we're not tax experts here. Heath probably more than me, but Heath will be covering off CGT and some of the things to consider there, Stephen. General time frame, yep, we'll be covering that off as well, Karen. Okay, so just keep posting any other questions that you have. Nikki's saying that she's a part of a franchise group, so really need to consider the franchisor and how and when to communicate the plans with them. Yep, fair enough. And a lot of franchise groups have that requirement. You really need to get approval, well, discuss the process with them, but also get approval from them before they are happy with whoever's going to be taking over your franchise territory. Okay, so let's. I'll continue on and just keep putting in comments into the chat box if as we go. Jeff's saying processes are mostly in your head. Yeah, what's the best way to start documenting that? So I'll talk about that as well. And some info about super. So I'm not sure if we're going to cover that, but happy to open that up in the Q&A, Stephen. All right, better keep going because I know that we are, we want to make sure we stay to time. But no, thanks for those additional comments there. So very briefly, the outline of the webinar, I'll introduce myself in a minute and cover off probably half of the content in the webinar. And then Heath will introduce himself and cover off his points as well. So there's 7 key considerations in total that we want to cover off. I'll share with you my 4-step succession readiness model. Now I work with a lot of businesses at this stage in their the business journey, and I'll just share with you how I go about that. And we'll also talk about some steps that you can take after this webinar to help you prepare for succession. Sorry, I'm just letting some people in there. And ideally, what we want you to do is leave with confidence and clarity after this, so you can take the next steps and start the process of planning for that succession in your business. All right, so just very quick intro from me. I think most people on here are already on my database or have seen other things that I've run. But just for those that don't know me as well, I'm a trained accountant. I've been running my own business coaching and consulting firm for over 30 years, for 17 years. But I have over 30 years experience in business, both running my own business and working within corporate and other commercial groups in the past. My main focus is working with businesses that are growing, established. They want to become less reliant on the business owner, more profitable, and therefore more valuable as well. And I will talk about business value and how to think about the value of your business as part of these seven key areas as well. And most of the people I work with are family businesses or multi-generational businesses. Okay, so let's get into the crux of the webinar and kick off with these 7 key considerations. All right, so the first one is really thinking about the time frame and plan. And I think Karen made a comment about what sort of time frame, how long does this sort of process take when going through it with your team and with advisors and so on. So I'm not going to go through general planning principles. I thought I'd just pop it up here. So just a bit of a reminder about what you should be looking in general in your business when thinking about planning. And these are the sorts of things I go through with my clients outside of the succession area. And it is about understanding where you're heading long term, thinking about where that, what the end game might look like, and then breaking it down into more short-term timeframes, and then obviously having a plan in place and implementing that plan through regular meetings with your team, with your with coaches, advisors, and everything else. In terms of succession, though, what we find is that you really need to at least look at a 12-month time frame and probably closer to a 3-year time frame. And Heath can share a bit more of his experience when he's presenting his information. But just recently, I actually had a client or past client contact me saying that he wants to sell the business in the next 3 years and wants to start getting a valuation of the business. Now, he has the business already set up with a general manager running it. He's no longer involved in the business. And even though it's already so well set up and doing very well, he's still thinking about a 3-year time frame. And I know with Heath, when Heath took over the business from his father, and I've obviously been discussing this with Heath, he actually wanted other people, not just himself to take over, but other people to start buying into the business. And so he actually had to start recruiting people that weren't even in the business with a view of them becoming potential owners down the track as well. So that even took longer than a 3-year time frame. So it really depends on what stage you are at your business, the size of your business, the complexity of the team. But I think 12 months to 3 years is the sort of time frame that you should be looking at. And the reason for that is to cover off these other points. It's really to maximize the profitability so you can get the most value out of the business, set it up so it's less reliant on you. Jeff made a comment before in the chat saying that everything's in his head. He needs to start documenting processes. So it's all of these things that need to happen. Documentation of processes, improvement of processes, development of the team, introducing the right roles in the business so that they can take the load off you. All of these things help make that succession process a lot easier, okay? And you can imagine that these things can take time in your business. Then also looking at who are the potential buyers, what are the different options to hand over. Sometimes if you don't have someone within the business that you have earmarked to sell or hand over the business to, it's about understanding what's happening in the market, who are potential other buyers external to the current team, and then maybe structuring the business and the attractiveness of your business towards those potential buyers. Okay, so all of these things need some thinking, need some planning, and need some time to put in place. Okay, and lastly, obviously, these last 2 points, which you will cover off as well, which is the time it takes to upskill the second generation and also to prepare yourself for life after business. Okay, so if you've got any questions about that, just feel free to pop that into your into the chat. But generally speaking, that's the first thing you need to think about is a long enough time frame and really putting the effort into plan this out. Secondly is really getting an understanding of what your value what your business might be worth. Okay, so I just want to cover off some very, very high level business valuation principles. And this is generally how a small business is valued. You look at your profit before tax, and there are some adjustments that we make to that, or a value we would make to that. So things like, you remove things like depreciation, interest costs, even your own drawings out of the business, and you multiply that by I'll just say a multiple at this stage, and I'll explain what that means. And that multiple generally ranges between 1.5 to 4 times. And I'll explain a bit more in the next slide how to think about that multiple. But as an example, if your business is making a profit of around about $200,000 and the multiple that applies to your business is 2.5 times, then broadly speaking, your business is valued or would be worth around about $500,000. Okay, so it's good to start thinking about this because you can start doing things to improve that value now, but also it'll give you a bit of an idea of what the dollars that you need to start thinking about discussing with the next generation of managers, okay, and start preparing them about this this whole concept of them needing to buy into the business rather than just getting the business for free. Now, some people might want to give their business away, but generally speaking, we encourage people to get the second generation to buy in. And there's a couple of reasons for that. One is really for them to ensure that they are committed to the business in future. They need to have skin in the game. Secondly, you might have other family members, for example, that aren't involved in the business. And if you give away the business to some of your siblings, some of your kids, then the others are really missing out. Okay, so there are a few reasons. Plus, you obviously want to set yourself up for retirement and those sorts of things. Okay. Now, Stephen's asked a question, is that equipment and stock on hand? So generally speaking, you add stock onto this, but equipment, if it's equipment to produce what you're doing, then it's normally built into this, because that equipment should be helping your business create profits. I mean, it's used to either manufacture things or to provide a service, produce products, to then be a profitable business. If you've got equipment that you've invested in, but your business is not making money, then really that equipment's not really worth much, apart from obviously just the sale, just the fire sale price. Okay, so generally speaking, it's profit plus stock. Sorry, this value plus stock. But once again, every business is different. Every industry is a little bit different. So it's best to talk to a valuer that specializes in your particular industry, and they might have different ways of approaching this. But so this is just a very, very broad way to think about it. Some of the things that can affect. Sorry, that was Siri chatting to me. And a few things that affect this multiple. Obviously, it depends on how involved the business owner is, how dependent the business is on the owner. If there's high dependency, then it's worth less because the multiple's lower. If there's low dependency, I'll say good systems, and it's a growing business, a growing industry. All of these things help build up that multiple. Okay. And then on top of that, there are other things that you might have specific to your business, your industry, that then adds to the multiple further. So it could be things like high barriers to entry, patents, trade secrets. So things that others don't have access to, and therefore it gives your business a lot more value compared to competitors in that in the same space. And lastly, there could be people out there who are looking at a strategic purchase. So I had a client who had a frame and truss business here in Sydney. They end up selling their business after initially thinking about succession with their family members. They end up deciding to do a trade sale and sold it to a Melbourne business that wanted to expand into Sydney. Okay, so there was a strategic imperative for that Melbourne business to pay a little bit more to secure an existing operation, existing customers, existing team, and just step in and start growing from there. Okay. So let me know if you've got any other questions as we go. Just feel free to pop that into the chat box. All right. So that's just broadly to think about how to value your business and what it might be worth. But as I said, you really should get a valuer in when you are thinking of having that discussion with the next generation and you're getting further down that track of planning. Third consideration is really helping to prepare the next generation. Okay, so most of the people that I work with have people within the business already earmarked or they are hoping can take over from them down the track. And as I said before, it could be family members or other managers in the business. So it's really getting them to get involved in some of the goal setting and planning for the business, getting them to think a bit more longer term. As we probably know within our team, people down the lower parts of the organization probably think in shorter time frames, and as you get up the organization, you start thinking in longer time frames. And so it's really encouraging that next generation of managers to think longer term and getting them involved in more of that longer term thinking. Obviously, ask them if they're interested in taking over one day, start developing their skills in terms of these sorts of areas, start sharing some of the numbers with them. Now, I've got clients that share their whole P&L with their senior managers to as a way to get them more involved. They might have profit share aligned with their with them taking over more responsibility, and this is all prior to them buying in and even committing to buy in. Okay, so it's all part of this process, and obviously start getting them to think like an owner. Start sharing some of the challenges that you face as an owner, some of the risks that you take as an owner, and just start planting those seeds so they have a better appreciation of what it means to be an owner. So any questions there before we move on around? Can I ask in the group here, who actually does have someone that they feel could possibly take over their business in the next few years, or the next 10 years, you know, depending on what stage you're at. So, so if you just open up your chat box and just pop that in. Say yes, someone, you could name that person if you want to, even if you're hopeful, just pop that in. Or if it's a no, just say no, probably looking at selling externally. Okay, so guys saying my 8 and 10-year-old daughters, so that's obviously planning ahead. So that could be 15 years down the track, possibly. Alison, yeah, a lot of law firms have keep adding partners, associates, and so on to who can then step up to becoming partner. Yes, a couple of possibilities from Patrick. Lynn saying a possibility. Yeah, okay, so there's quite a few. Dirk saying yes, family members, internal staff potentially. So it's I think attending this sort of webinar is useful because without exposing yourself to this sort of thinking, you might automatically assume that you can't, or you don't have anyone, or it's too difficult. Whereas if you start planting the seeds even within yourself of what might be possible, then you can start developing people that you already have in your team and start having those conversations with them. Okay, good. All right, so so now it's my turn to stop talking and hand over to Heath.
Hello, everyone, and thank you, Anil, for today and for giving me the opportunity to talk about the field of business succession. It's an important field, and obviously everyone here thinks it's important. Otherwise, why would you be here on a beautiful day like today? I've lived the experience of business succession in my firm. Having started in a practice that was established by my father in 1997. I came into the practice in 2003 and became a part owner in 2006. Over that time, I've had various partners suffer catastrophic injuries and be in a coma for 4 weeks. We've had partners that have left, some in good and some in not so good circumstances. And I have gone through a process of helping transition out the more senior partners in my business once they're getting to the age of retirement. So where I sit now, I am the Managing Director of Adams & Partners Lawyers. When I started in the practice with my father in 2003, I was the youngest lawyer, and in 2006 became one of the younger partners in the practice. To where I am now, I'm now the oldest solicitor and the oldest owner of the business. I share my ownership of the business with 4 other directors, all of whom are practicing lawyers or conveyancers. The process of dealing with contingencies like directors becoming ill and unable to work in the business, the training up and recruitment of potential successors and getting them into the business in a way that they can afford, and helping transition people out of the practice, including my father, are all the experiences that I have gone through in my own business, which is, I think, relevant for many of you or some of you who are contemplating succession planning at the moment. So I come to this field not only as a lawyer with experience in terms of acting for lots of clients in this type of area and in other business matters, but also having lived the experience of succession planning. It's a fascinating area. It allows for lots of creativity, and if it's done right, can add value to the departing owner, ensuring a proper retirement and a proper future for them, but also ensure the continuity of the business that they have created and ensuring the legacy that they have created. So, Anil, I'll go to the next one, the commercial considerations of succession planning. So essentially, what is succession planning? Anil, I think, has pretty much set out the concepts of succession planning, but how I look at it is essentially around 2 elements, and that being the concept of ownership succession and management succession. Clearly, for the business to continue, you need to have people who can come in and take over the operations of the business. And also clearly for a departing owner to vacate the business, they want to get paid or at least recognised for the investment they have put into the business over time, obviously. And hence Anil's point about valuation and those sorts of issues, which I'll come to a little bit later. From my perspective, there are lots of ways in which succession can happen in a business context. The focus of today is really around family succession and essentially employee management succession. I will touch on a little bit around trade sales, although that's more of a concept of selling the business and extracting as much value as you can to a third party. There are other means to depart from a business like franchising, like public listing, like essentially winding down the business. The focus is on family succession and employee management succession. That's essentially what most of my clients are looking to do. And in particular, in small businesses, you're looking at family business succession as being one of the primary focus for most business owners. The statistics essentially say that about 41% of small businesses are looking to have a family member succeed. So essentially, for succession to happen within the family, a whole lot of things need to be thought through. There are advantages and disadvantages of doing this. The obvious advantage is that it ensures the continuity of the name, ensures the protection of the goodwill and the legacy that was created by the owners. It allows for flexibility for the family members in terms of how they craft a deal, and can potentially ensure that the family goodwill and dynamics are maintained by ensuring that people move on and take over the business. Having said that, family succession is pregnant with risk and problems, mainly brought about by a potential culture clash between family members, particularly the older and the new generation. There can be problems with the relevant incoming family members not being chosen or being overlooked or not being offered the opportunity. And clearly for a departing owner, there can be the concern about bringing in the right people who have the right skill to ensure the continuity of the business. Having said that, those things can be dealt with if it's done appropriately, and Anil touched on that issue earlier in terms of the way that you have a new family member come in and pay for their share of the business, so as to ensure that from an estate planning point of view, we're not setting ourselves up for a problem once we pass away. There are other things to do, but essentially that's part of the succession planning process. I've done that obviously in my business in terms of buying into the business with my father and learning the dynamics of operating in a business where you have both a business and a family interest. And that's an interesting process to go through in separating the dynamics of family and business. The other alternative, employee management succession, is perhaps the more common scenario I see with a lot of my clients, given the size of their businesses. It allows for people to pick the right managers and employees or partners who they look to succeed them, to train them up over a period of time, and to ensure that there's enough flexibility around their buy-ins to ensure that not only does the departing owner receive the appropriate remuneration, but also that the incoming buyers or incoming employees are not financially hamstrung and thus causing more pressure upon the business. So they're the two types of succession arrangements that I see and am involved in. In terms of a trade sale, that's more focused upon selling the business to a third party to extract value. I would reiterate some of the elements around what Anil said in terms of having appropriate processes and systems in place. But one of the other things to consider is ensuring that you have a lock-in of the employees in key management. Any buyer of a business from a trade sale perspective will want to make sure that key clients and key staff are retained as part of the business, particularly if they don't have the experience or they want to ensure the continuity of the business. So you need to start thinking, you'll need to start to think those things through well and truly before you look to go to a trade sale type arrangement. In terms of great questions, just come up, how common is vendor finance option? In our space, small medium enterprise, I'd say it would be in more than 50% of all arrangements that I'm seeing, either in a trade sale or a succession planning perspective. Particularly for family business succession, it sort of has to be, given that the younger members of the family typically don't have the resources behind them to buy the business to appropriately pay out mum and dad. So that leads into the flexible buying options. Clearly, there is vendor finance, which is where the departing seller defers the payment of monies to them over time, essentially acting as a bank. There is other arrangements that you could put in place, like a stage buy-in, so that certain amounts are paid over a period of time before the ownership interest is essentially divested. That allows for the business to continue to pay profits to the new owners, and they then pay out the existing owner over time. One of the other elements I've seen in businesses is where there's non-recourse loans. So essentially, the departing owner will provide vendor finance and only receive repayment on the basis of the flow of dividends that come from the shares or units or the asset that they have sold to the incoming owners. And if that's not paid back within a certain period of time, then the owner takes the risk and essentially doesn't require any further payment. There's lots of options, and as they say, there's many ways to skin that cat, and it depends upon the appetite of all the parties and what they want to do, and pricing, and a whole lot of issues.
So Heath, on that non-recourse one, then that basically means that if the profits aren't there and therefore the dividends aren't available because the profits aren't there going forwards, then it's the current owner or the vendor who is taking that, sharing that risk, I suppose, with the new owners. Yeah,
I mean, and that's one version of a non-recourse loan. The other version could be that in the event of default, that the departing owner can retake back possession of that asset, be it the shares in the company, for example, but nothing else from the purchaser. There's earn-out arrangements. There's lots of things that can be discussed, but given the time constraints, all I want to say around the flexible buying options is that the price that you propose to sell out and what the departing owner is looking to receive will determine, and the ability of the purchasers, incoming owners to fund that will influence how flexible everyone needs to be. In answer to the question that came up, at least in my experience, most types of business sales, be it succession planning or trade sales or whatever, will require some form of vendor finance. It's not uncommon, and people need to get their minds around that. Most vendors who are looking to sell are prepared to accept that because their options to sell otherwise are limited. Just going back to the commercial consideration point, my last point around aligning your risk as a director and ownership of the business is clearly, if you look to sell your interest in the business, your ability to make decisions about its ongoing operations and decision making is limited, or it could be. And so what a departing owner needs to take into account is, well, how soon do they want to hand over the reins? What sort of decision-making responsibilities do they want to pass on to the incoming buyers? Is it staged? Is it holus bolus? What is it? From an incoming buyer's perspective, they would typically want to have the right to make decisions around what type of practice or business they want, and having the old departing owner hanging around like the ghost of banker does not help in terms of allowing for freedom of choice and for change in a business. And that's particularly important when it's an older departing owner who has a specific view, and clearly they would, given that they've set up the business, and change. And then when they start seeing change, it becomes potentially a point of conflict. I'll move on to the next slide, Anil, if we could. So going on to legal considerations, there is essentially a few things that need to be thought through around how to structure a deal. When I'm looking at succession planning or a trade sale, the first thing that I need to look at is what is the structure of the business and what is the structure of how that ownership interest in the business is reflected. There are multiple different ways that a business can be owned or operated, from a sole trader, partnership, company, unit trust, hybrid arrangement. There can be multiple entities that own different assets. Depending upon that structure, it may, in some circumstances, dictate the nature of the transaction to transfer that ownership interest. Typically, there are two methods to transfer an ownership interest, and that is by a share sale or an asset sale. An asset sale is as it sounds, you sell the assets, the goodwill, the plant and equipment, the rights to material contracts, intellectual property, whatever the business assets are sold from the owner of that business or the business itself to the incoming party. A share sale is different in so much as the right to operate and own the entity which owns the assets is transferred. So in the context of a company, for example, the shareholders are the parties that own the company which runs the business. And so to transfer the ownership of the business, you could simply transfer the ownership of the shares from the outgoing to the incoming party. Each deal is different, the requirements are different, and the risks attached to share sale and asset sales are different. In my experience, a lot of transactions, most transactions are done on the basis of an asset sale arrangement, as it avoids some of the risks around liabilities and unknown, or what are called contingent liabilities. Having said that, though, the selling or departing party will determine typically the nature of the transaction. And that's where tax considerations come into to play, particularly where the business may be operated through a company structure. And so as to maximise tax concessions, a share sale may be more tax beneficial to the departing owner. But structure is important in terms of who the vendor is. It's also important in terms of who the purchaser is, and how you structure the price. I think I've touched on that a little bit. I know Anil has in terms of valuation principles, but how that price is ultimately paid and what are the conditions around that purchase price are also important. I touched on previously the concept of an earn-out arrangement. That's not uncommon in a lot of sales where the purchase price is set. The purchaser will agree upon paying a certain amount at the time of completion and taking over the reins of control of the company or the business. And there's a portion left over that will be paid out to the vendor subject to the ongoing performance of the company. What that does, it gives the purchaser some insurance in the event that there's a downturn in business or a loss of clientele due to the departing vendor or other matters. For the vendor, it can be beneficial in that they can extract a premium in terms of price, given that they're basically standing by the fact that their company is a good business and capable of maintaining the earnings that it was making whilst that owner was holding the controls over that company. So structure is important. Again, creativity can come into the structuring of that deal. Vendor finance and related recourse, I won't recap that too much because time is short, but essentially how money is paid and by whom and over what terms typically also form part of a deal, as does the last point about transferring the interest over time. You don't need to transfer 100% of your interest in the business at one point. It can be done over a period of time. It can be done by way of a transfer of an interest to multiple parties over time as well. That's certainly how we've structured our succession planning in our business. In terms of documenting the deal, all I can say, and it's going to be no surprise to any of you, even though I'm a lawyer, is that you should document any deal that you do as it relates to selling a business or succession planning. Now, lawyers love court cases, and I was looking at a few court cases in preparation for this presentation today, and there are a lot of court cases, particularly involving farms, where mum and dad have had a discussion with the son or the daughter out at the woolshed, agreed on a plan to sell the farm, and the deal falls over because times change, people's expectations change, or whatever. The end result is a broken family, litigation, and no succession planning whatsoever. So where you have a clear succession plan, you should document it. Where you have agreed terms, you should document it. If there's financing or ongoing decision-making, it should all be documented. So the purpose of a business succession plan in writing, and this might go to, I think it was Jeff's question about where do I start? I think this is where you start. What do you want to do in terms of your succession? Who have you identified? What are your expectations of them? What training program are you going to put them on? What will be the proposed price or the method of valuing the business down the track? And start putting those things into writing with the concurrence of the people that you're identifying to succeed you. That will at least give a roadmap to all of you as to what is planned between the parties. And it should be focused on, Anil was suggesting a 12 to 36 month timeframe. That's not an unreasonable timeframe to start putting these ideas down in terms of a proper succession plan. Once the relevant preconditions are satisfied, so a time frame, for example, or skill levels, or any of those conditions are met, then at that point, the document needs to be drafted for this actual transfer of the ownership interest. And I'll go back to my points previously about the share sale or the asset sale type agreement. That agreement needs to be in writing. There will be a myriad of things included in that document, including the price, the terms upon which that sale will happen, the conditions of whether that sale happen, or for that sale to happen, such as the assignment of interests or leases or contracts or whatever it may be, warranties and promises and indemnities and those sorts of things. It is a legal document. It is best to draft it properly. You should get lawyers involved in terms of doing that. Assuming that there's vendor finance of some arrangement or financing of some arrangements, then that should be documented, typically also to confirm security. I will move on to, I think, my last point, Anil, now, just jump through to that tax. Okay, so everyone wants to know about tax. And whilst tax is not the tail that wags the dog, it should be treated pretty importantly. And in fact, it's the starting point in terms of a lot of your thoughts around succession planning. The big tax is capital gains tax. And the big idea and the big thought is, how can I minimise the amount of tax that I need to pay to the government? There are two essential CGT or capital gains tax things that people need to be aware of, and they need to talk with their accountant about and get advice about before they enter deals, so that the deals are structured properly. The first one is the CGT discount. Provided you own an asset, such as a business or a share, for more than 12 months, then you can claim a 50% discount on any capital gains that you make upon the sale of that asset, whatever it may be. That concession is only available to individuals or to trusts or to superannuation funds and not to companies. And so, for example, if a company is selling a business as an asset sale, the CGT discount would not apply. However, there are other means of trying to maximise that discount, which you can talk through with your accountant. The small business CGT concessions are the important one. That does apply subject to certain conditions. The two main conditions are that the asset that you're selling is an active asset, so essentially an asset in a business, and that the person selling that asset meets either the net asset value test of having assets no greater than $6 million, or the business itself has a turnover of less than $2 million. If those preconditions are met, then there are a suite of concessions or exemptions that are available to you. That applies, question from Stephen Carruthers, does that change pending share sale or asset sale? No, it doesn't, provided that the share is part of an active asset. Okay, so not all shares held in companies are part of a business that would be deemed to be an active asset. So to give you an example about why it's important to talk to the accountant and to structure the deal properly, the 15-year exemption that I referred to in the slide there applies. Now, I've had clients that have held an asset, held a business for 14 years and 6 months, and were about to do a deal, about to sell their interest to one of their It's a trade sale in that instance. And so it would not have made any sense to do that at that point. And so we advised them to wait 6 months before the deal was entered into. By doing that, they met the test of the small business concession. Because they had held the asset for 15 years, the capital gains that they made on that sale was completely wiped out. And so the tax that they paid to the government was nil. I think because of time, I think I'll leave that there. I might just go to the last bit, the prior year tax losses. Let me talk about that. The last point around that one is if you have a company in particular that has retained tax losses, it may be advantageous to you to look to sell the shares in the company to the prospective owner so that they, if they still meet the same business test, can essentially rely upon those tax losses to defer or to minimise their tax obligations should the company make a profit in the future. Structure is important. Maximising the tax concessions you get is important. Working with your accountants and your lawyers to get it right is important. I think that'll do for me. Anil, sorry if I rushed through to everyone, but
no, that's great. That's great, Heath, and some good examples in there as well. So I appreciate that. And I know we're probably a little bit over time, but I think it was useful to answer some of those questions as we went along as well. So lastly, just the last point is really to help prepare yourself, because I know we all spend so much time in our businesses. Our identity is so linked to our businesses that we really need to get ourselves ready mentally and physically to start letting go. So really understanding these points, such as, really what you need financially in retirement, start putting a plan in place to start reducing your hours, start with an hour a fortnight, a day a fortnight, and then a day a week, that type of thing. Just starting to think about how you can start letting go and preparing yourself for life after business. And if it's the other good thing about a family business succession is that, as Heath said, there's more flexibility. So there's more opportunities for you to come in 1 or 2 days a week, even after the business has been handed over and the ownership has been taken over. So depending on what sort of succession you look at will affect how you need to prepare yourself as well. But obviously looking at hobbies, building social networks, rethinking what's going to get you up in the morning, what's your purpose after business. Okay, so just a few things for you to think about there. And I did put in one extra, even though we did say 7. Just lastly, a bonus point is really just understanding who to talk to. I think we've covered most of this. The 3 main people would be commercial lawyers, such as Heath. He's covered off those sorts of points. Your tax accountant, definitely. And just be careful that your accountant is up to, it has the experience needed to ensure that you can maximise your tax position, because not all accountants may be across all of the opportunities out there. And then obviously, someone like myself, I work with a lot of businesses to help them more in that phase leading up to looking at legals and engaging with someone like Heath to really help prepare yourself, the next gen and the business in general. All right, so just very quickly before we head over to the Q&A, just sharing with you my succession readiness model, which are really the points that we've already covered. Getting yourself ready, getting the next gen ready, getting the business ready, because if the business is tuned up and has the right systems, the right team in place, it means it becomes a lot easier for the next generation to take over and then to run that business successfully. All right, so I really do put a lot of emphasis on helping maximize the opportunity for the next generation and maximize then the opportunity of the business succeeding and growing after you depart. And then lastly, a lot of the things that Heath's covered off, which is really getting the succession plan, the legals, the commercial considerations in place so that you are succession ready. Okay. And I'll skip over this one, but I think I had a few of these on my website. But really, this is the things that drive me. It's really seeing the results. It's really seeing a successful transition and seeing these businesses handing over from one generation to the next, which really provides me with a lot of satisfaction, and I'm sure it does Heath as well. Now, before I hand over the Q&A, just want to let you know that I am launching a program for this, for businesses in this space. I won't go through this in too much detail, but basically it's a program where it provides the current generation of owners a group to discuss issues with, to hear what others are doing to prepare their business, to prepare themselves. So this is a group program where there's first gen or current gen owners discussing things fortnightly, the next gen owners discussing things with their other peers, their second gen peers in a separate forum, getting everyone together within the business every month to review plans, review financials, and obviously bring the first and second gen together. Having all of my clients come together, which I do already, for a quarterly forum where we plan, discuss issues, and put a new plan in place. And then obviously there's skills development for the second generation and so on. Okay, so I'd really be keen to get some feedback from those of you, not now, but maybe a little bit later down the track, to see if that sort of program that I'm going to launch later in the year is something that resonates, could be useful for people, because I really want to fine tune it and make sure that I get this program right. Because it's really a combination of what I'm doing already with my clients in a one-on-one setting, but also another group that I'm running. I just want to meld these and create something that's really going to be useful and valuable for people looking at succession. And lastly is at the back of this, I'm just going to open up my calendar. Anyone who wants to have a chat about succession in their business, wants to talk through any of these issues. I talked with Heath that I'm happy to field those initial discussions. And then if I feel that it's the right timing for you to talk to Heath, then definitely pass your details on to Heath and put you in touch. But also just to talk about succession in general in your businesses. So what I'm going to do is just into the chat box, I'm just going to copy a quick link, and you can go straight in, and I'll just copy that in. So just click on that if you want to book in a session. I've made my calendar open for the next, for the rest of today and the next few days. So just book in a time whenever you like. All right, so let's open it up for Q&A, Heath. So who has any questions about anything that Heath and I have covered, anything specific to your business that you'd like us to answer? This is your chance to get some free advice from a lawyer that normally charges a bit more than free. So feel free, if you have any questions, just unmute yourself, and happy to field anything. Karen is asking a question here. Karen says, is it possible to sell your client base? That's exactly what an asset sale is. Heath, do you want to just, or part of the assets within a business, do you want to just discuss that quickly, Heath?
Sure. I mean, your client base depends upon the nature of your clients and how they're retained. But at the very least, they form part of the goodwill of the business. You have clients that come back. The stickiness of those clients will then feed into your ability to have earnings for your business, and that feeds into the formula for valuing the business overall. Some client contracts are fixed; they're subject to assignment provisions, and they would be capable of being transferred or assigned upon an asset for a share sale in certain circumstances. So, yes, you can sell a client database. It really depends upon the likelihood of those clients being transferred to a purchase.
Yeah.
Thank you.
And I think a lot of people have obviously, very long-standing loyal clients, but just selling a database on its own is probably, it doesn't ensure that those clients are then going to stick to whoever buys that database. Whereas if they bought the business and the name and the current systems and the ways of doing, continuing that relationship, then there's obviously probably more value for the purchaser. Yeah. Any other questions? So a few people are saying thanks. So we'll, here we go. Guy's saying, are you experienced in assisting people in franchises? Yes, I actually referred someone recently to Heath about who was looking at franchising. Heath, you've obviously specialised in franchising as well, I know.
Yes, I've been involved in the setup of 20, 30 franchises and have acted for franchisors and franchisees for 15 years. So most of the issues that you'd ever see in a franchise setup, I would be familiar with. Nikki Cooper's question around ANZ and franchising, yes, there's typically a first right of refusal that you need to go back to the franchisor on and consent around transfers. But yes, you do need to work with the franchisor, but there's mechanisms to transfer a business even in a franchise.
Yeah. And I think Guy's question probably relates more to, because I remember Guy mentioning something earlier. He's looking at maybe franchising his business as a succession strategy.
And that is a strategy. It's a more complex one than what we've been talking about, but it's certainly a strategy that I'm familiar with.
Yep. Good stuff. Any other questions? Here we go. Jeff, what suggestions do you have for a business like ours, which only has me and my partner operating it? We have no employees, but a very healthy P&L, no successes in mind. So Jeff is a property consultant. So Jeff, it's once again, I think we really need to look at what are the benefits of someone buying your business. Is it systems? Is it relationships with current suppliers? What are things that are going to help them continue ensuring that they're going to continue to see those profits going forwards? So I think it's probably something that we probably need to have a look at your business and really understand what those benefits or assets are within the business. Heath, have you helped people with businesses that are probably it's just them or a couple of people? Now, I know within professional circles, such as accountants and solicitors, there's generally a fairly standard way of valuing those smaller books of clients, but within a property setting, I'm not sure if you've had any experience.
No, not specifically. Valuations, it's a very discrete skill, which is outside of the framework of a lawyer. The model that you put up in terms of the 2 or 3 or 4 times or 1 times valuation of future maintainable earnings would be the most common, and each industry is different. So you do need to get a sense of value, and that's where the broker or the valuer will come in handy. I think if you're operating really as a family partnership with no potential prospects in terms of employees or family members to take over, then your focus is on other means to exit, and that's trade sale or a merger with another firm and then looking to have them buy you out over time. I think that would be the more relevant options for you.
And Jeff, I think, as I said at the start, in terms of planning, you just need to start planning who are potential buyers. If it's someone in the industry already that they want to just add on the volume of your revenue, your clients, those sorts of things onto their business, then there's definitely value in that, especially if those buyers are regular buyers. Obviously, they are investors because that's who you help, and there's definitely value in buying those clients, I suppose, which is similar to Karen's question earlier. But the more independent the business is of you, the more valuable it will be. I know it can't always be that way in a small business, so you're looking at probably other buyers that don't need, they already have experience and they can leverage the relationships you already have in there. Guy's also asking, how long will sellers usually stay working within the business? Once again, that depends. If it's a succession to family or existing managers that you have a long-standing relationship with, then generally people, the current vendor selling the business may hang on for quite some time in an informal way. But if you're doing it as a trade sale, then that obviously depends on the arrangement, and that could be 6 to 12 months. Heath, do you have any additional comment there?
It's contextual. So sometimes, particularly if there were to be an earn-out arrangement, the departing owners would like generally retained as a consultant and they're generally incentivized to maintain the profitability of the business because they'll get the big earn-out payout after that 6, 12-month or 24-month period. Most trade sales, the involvement of the vendor is limited. Sometimes for 7 days afterwards, after settlement, sometimes they're retained as a consultant. That may be more likely if it's a professional service type sort of business. But generally, a vendor wants to move on. So there has to be a reason. It's contextual.
Yeah. And I think most vendors want to move on. Most, some of the purchasers, let's say there are, business relationships that will take some time to hand over in terms of, ongoing business customers that need a bit more of a transition to whoever's going to be looking after them going forwards. That can take some time to develop the relationships and the trust with the new purchasers. So I can understand that purchasers may want a bit more time. And as you said, Heath, it may not be an employee role. It could be a consultant, something like that. Any other questions? Letting go is a tough one, Guy said. Yes. Where can we get resources with mindset? Yeah, happy to. It is. It's
very hard.
Our lives, business, the business that we've built. How do we let go of our baby? It can be tricky. So no, definitely understand that, Guy. But happy to have a chat about that.
Yeah, my father retired 30th of June last year, and the first month we didn't see him, and then in the next 4 months, 5 months after that, he kept on coming to the office wanting to see how everyone was going. He missed the routine. He missed seeing people. Not so much the work, but that's what he missed. And so it's a very tricky proposition for people leaving a business, particularly if they've set up their business. Change the locks. I thought about it. Can I just say that? I thought about it.
and Guy, that's why I had that slide, that seventh point. It is about building those social networks outside of business, starting to get involved in other things. Ideally, if you can scale back, obviously it's not always easy to do, but setting up the business so you can start working less and maybe doing other things outside of the business, all of that will help with that transition. Yeah. All right, we better wrap it up there, actually, unless any other questions before we wrap up. Otherwise, really appreciate everyone taking the time to attend, listen, ask questions, contribute, all of that. It's great when there's a bit of interaction, and I think everyone learns from that as well. So once again, I'd like to just thank Heath for joining us today, and for all of you, and definitely happy to have a chat to anyone, review where you are in your business, whether ideally if you've got someone already in mind where you've got potentially someone to take over, whether you're thinking you might be able to take over, happy to talk about those things and see what steps you might need to take. Okay, so